Very good morning, friends. At the outset, let me welcome each and every one of you. Fast Track webinar series exclusively for IBBI evaluation exams, securities or financial assets. This is batch number 17, day number 4. And we are today going to see a very important topic. I'll say a bit technical, but lot of scope for scoring marks. I'll just share to you the syllabus part of it. Please look at the syllabus. This is your 33 mark valuation application. In that, the fixed income securities part is a very big topic. It goes add to this. And of this, I'll be doing in 2 days, today as well as tomorrow. And this is your fixed income securities topic. It starts with what are the types, debt instruments, terms used, duration for bond, then FIMDA circulars, various derivative products, and options. I suggest that you first complete options part of it. Generally, this topic per se on option valuation and valuation of other financial assets and liabilities, very important topic. The first two alone will take a lot of time because there are fundamentals of options you need to understand because there are general principles and option valuation models. There are possibilities you may even get a case study, maybe an application of Black-Scholes. You have Ind AS 102, which is on share-based payments, and especially with respect to ESOP valuation. Nowhere in the syllabus they discuss about ESOP, except in your syllabus on top, where you have on general laws, where on SEBI, you have the SEBI share-based employee benefits regulation. In that ESOP scheme is there. But of course, this is from, and also the stock appreciation rights, employee stock purchase schemes. These are all from the regulatory perspective. But from a valuation point of view, nowhere they have discussed that, we will ask a question on ESOP. So possibility, and especially in the past 1 year, there are case study questions based on ESOP, and which is based on the option valuation, especially Black-Scholes. So therefore, you can't ignore whether it is included in the syllabus or not. Similarly, please look at the other part. This is your valuation of other financial assets and liabilities. I'll just share with you that topic. Look at this. So especially what is the concept of a financial asset, financial liability. So I'll be discussing a few questions in that. So this is from Indian Accounting Standard 32. That is the definition of financial asset and financial liability and all this stuff. So you will know what is meant by a financial asset, financial liability, non-financial assets and non-financial liability, and valuation of instruments like financial guarantees and warranties. So I'll be doing case studies on this. For example, there are case studies on warranty valuation, and based on that there will be a claim recognition or warranty provision recognition in books of accounts, and how these warranty claims are actually measured and what is your so therefore, even though the Indian accounting standards, if you look at this Ind AS part, look at the INDAS, they generally include only Ind AS 36, which is actually impairment, and 109 financial instruments, business combination 103, fair value measurement 113, intangible assets 38, share-based payments 102, and apart from that, you will also be tested on concepts of financial assets and financial liability, which is taken from Ind AS 32. Now, please understand the content of Indian Accounting Standard relevance in valuation. So, not the entire Ind AS that is relevant, but only the valuation part, which has been prescribed in the Indian Accounting Standard. So your syllabus is then and there. There are very few places you have all these spillovers, and over a period of time, they are now matured enough to ask questions, direct questions, concept-based questions. So therefore, please pay your kind attention to actually appreciate the conceptual clarity on all this. And of course, financial guarantee valuation and financial warranty, I mean, the various warranty obligation valuation. So especially I have few questions on that also. This is a valuation of financial guarantee. So there are various case studies on this, especially based on Black-Scholes model. So let me now take you to, these are all some of the reference books. So especially this is a technical guide on valuation. And in this book, there is one particular chapter on valuation of options. Please look at this. This is chapter number 78. It only runs for 4 pages. Maybe as a beginner, you can go for this particular chapter, but remember, each paragraph is actually, it is in a concise form, and they only discuss the concepts. So not much of examples will be there, or nothing will be there. So only the concepts will be there. So this is, I will say, a very, it is not a diluted version, but a very concentrated version. Okay. So highly concentrated version in just 4 pages. Very, very concise, but it will give you how you may not feel the depth of the subject unless and otherwise you try to unravel the mystery behind it. So let me now take you to the options. Please understand, guys, option is not a new concept to India. We are all used to it. How? It is there in our culture. It is there in our practice. How? Like agriculture. Okay, agriculture. And the concept of option came when business objective got introduced in the agriculture. Now, in agriculture, once the farmer tills the soil and sows the seed, he very well know that within another 2 months or 3 months, there will be a harvest. So he will enter into forward contract. So I will harvest 10 bags, 100 bags of rice or maize or whatever it is, bajra. So I will deliver you 100 bags. 3 months later, what is the price today? So these are all forward contracts. So forward contract slowly became a business element you add in it. For example, 1 bag I enter into forward contract for 40 rupees. Now, 3 months later, market is at 48 rupees. In market, you can sell at 48, but you have already promised to sell at 40. Now, will you sell to the forward as per the contract 40, or you will cancel that forward contract, go to the market and sell at 48? That is where option contract. So your option contract is a forward contract where you have an option to either cancel the contract or execute a contract. So that is why there are certain terms that will come. Spot price is today's price. Holder of the option holder. Sometimes I have the option to sell. Then option to sell means I am a put to holder. The concept of call and put is a technical term to the holder. If I have an option contract to sell, I will put. If I have an option contract to buy, when I will buy, market is 48, contract is 40, then I will buy as per the contract. I will not go to the market. When option to sell, contract is 40, market is 40, I will not exercise at 40. I will go to the market and sell at 48. So please understand these fundamentals. So once business is clear, option will be automatic. So the 3 months later price, we call it as excise price. And since there is a contract and holder is having the option, the opposite party is obligated. So if I have an option to sell, opposite party is obligated to buy. If I have an option to buy, the opposite party has an obligation to sell. So the obligated party also will sign the contract. Holder also will sign the contract. Since there is an obligation on the other side, the holder have to pay him an upfront fee. And that upfront fee, we call it as option premium or value of an option. So naturally, this concept is what you have even in ESOP also. Yes, 3 years later, a share will be allotted to you if you continue to work in my company at a particular price. At a particular price, because they will pay the money to the company and I will allot shares. But I am obligated. Option is to whom? Option is only to the employee. Option is only to the employee. So employee has the option to buy. That is why it is called call option. ESOP is a call option to the holder. Who's the holder? Employee. And I'm a writer. Company is the writer. So writer means I have an obligation to sell. I have an obligation to allot the shares. Now there is a premium. That premium, option premium, this option premium is not collected from the employee. Please understand. So therefore, it is a cost to me, and I have to recognize in books. So how do you value this option? So that is why your question is very, very relevant in ESOP case studies. And please understand. So these concepts have a practical version also. So let me now go to the question directly. The intrinsic value of a call option. Actually, I want to make one observation. This is the intrinsic value. Look at this. Now I'll take a call option alone. Okay, call option. Now what is the call option? Option to buy. Now the option to buy is 40 rupees is the excise price. If the market price is 48, okay, I will definitely buy at 40. So current stock price is 48, but I have a strike price, excise price is 40. Naturally, I am gaining 8 rupees. It's called 8 rupees gain. To whom? To the buyer, option buyer. So that is why intrinsic value of a call option is you have the stock price minus strike price. Strike price is excise price. So you have to be very careful with these kinds of concepts. Okay. Similarly, you may also get a question on put option. Remember, guys, don't just read this and keep it in mind. Take a pen, pencil, notebook, okay, and then note down all these concepts, okay. So this is one type of question. There is other type of question. Please look at this. You may have questions on general principles, not only on these kind, but also, please look at that. You have 3 types of option contracts. One is an American option, European option, Bermudan option. American option, their option can be okay at any time. Any means A. American is A. So American option means from today 3 months. Anytime it can be exercised by the option holder. An option writer is obligated to fulfill. Okay, if I am a call option, I have the option to buy. But a put option, I have an option to sell, and the opposite party is obligated to buy if it is a put option. European option can be exercised only on the exercise date. Okay, E European, E expiration date. Okay, American option, A anytime. So A. So Bermudan option is like a staggered every 10 days once, every fortnight once, every weekend once. So that is why several specified dates. Now answer this. Which option allow an exercise of his option on any several specified dates? It's not American or European. There is nothing, no concept called Australian. It's only Bermudan. Now, I'll now take you to this concept of the factors of affecting pricing of options. Okay. Now, I want to make one observation here that you have various, this is your syllabus. How do you value an option? Because just now we saw option valuation, otherwise called as an option premium. It is a price, upfront price paid by the option holder, because I have a right, you know. So I have to pay this to the writer. So the option holder is paying upfront fee and upfront charges to the writer. But remember, in ESOP, employee doesn't pay. So therefore, it is a cost to the writer, and I have to recognize in books of account. So this is a very, very important case study, especially option valuation. Okay. So once you understand these concepts, it will be very, very clear in an advanced case studies. Okay. So now In the general principle, I want to bring to your attention one very interesting question. Now, please look at this. Now, this is called option pricing model. Okay. We have various option pricing model. Look at the syllabus. There are Black and Scholes model, Black and Scholes Merton option pricing model. So now there are two things are there. This is Lakshmikant and Pyarelal. Lakshmikant, Pyarelal, and one more person is also joined. So this is 2 persons. This is 3 persons. There is a difference between Black and Scholes and Black Scholes Merton option pricing model. Please wait for some time. I will explain you the difference. Then you have binomial tree method and Monte Carlo simulation. Binomial tree method also, possibly there is a question on case studies also there. So all these case studies I'll try to cover on Sunday evening 7 to 9 p.m. as well as on Monday evening 7 to 9 p.m. Okay. Now I am also giving you one more option. Okay. So now I am not an option holder. I am an option writer. Okay. I'm obligated. Okay. What is the option I'm offering to you? Do you need one more class? Because tomorrow will be the 5th day. 6th day is Saturday. Saturday morning 8:30 to 9:30. Do you need one more class? Okay. If you need one more session, please go to the blog and give your feedback about the 3-4 days, 5 days session, and also put a request whether you need a session. So to those people, we will send a link because the link will work only for 5 days. If you need for a 6th day also, please go to the blog and give your feedback and your request. Okay, good. Now, and along with if you need a case study session also, you can put a request there. Good. Now, I'll now come to this question. These are the factors affecting pricing of options. Now, there is a transaction which will happen 3 months later. So, today's price, 3 months later exercise price, time period is 3 months. Maybe if 3 becomes 6 months, risk is more. And since there is an obligation on the writer, he may need to keep the stock. So there is a cost of the stock. And since he's investing money in that, there is an interest element in it. So interest cost. And price of the instrument may be volatile. Okay, it may go up and down in case there is a market based. Okay, pricing is there. So there will be a volatility. Sometimes volatility will be very, very, very less also. Okay. Then between this period today and 3 months later, there may be a possibility that dividends will be, what do you call this, issue. Dividends may be announced. Now, I'll give you an interesting example. Now, there is in India's 102 share-based payment. As and when there is a concept called vesting and there is a concept called allotting. Vesting means when he completes the period of the employment, so he will be vested. He has a right to get the share, but he will not exercise the right. The moment he exercises the right, allotment has to be done because he has to make the payment. So vesting and allotting are two different concepts. Okay. Now, if it is vesting, that means he has the right. Now, in case you actually announce a dividend, will you give dividend for the vesting shares also? These are all very interesting questions. Please understand, you don't have answers all these things. You have an answer in India's 102. By default, India's 102 is applicable for your examination. I'm telling you. Okay. Very many concepts you need to understand. Because your syllabus, look at your syllabus. And there are many questions they ask. Delisting valuation is there. Then ICDR valuation is there. PIT regulation valuation is there. SAST valuations are there. You need not read the entire regulation. I'm telling you. Please. Wow, there is a understanding that, oh my God, regulation, so much. Okay. For your information, FAMA. Okay. For your information, FAMA. Foreign Exchange Management Act. Okay. Look at valuation under Rule 11. You have the Income Tax Act. Okay. Similarly, you have the transfer pricing. ESOP plan. Okay. There also valuation. See, ESOP has been put in two places. ESOP plan and scheme. ESOP option. 2 places it has come. So that is why case studies on ESOPs are very, very important. Okay. Similarly, valuation under IBC. Look at this. So it is not that the entire subject is relevant. No, TOPA, Transfer of Property Act, I have to read it. Not necessary. Only those areas which has relevance to valuation. So that is why please focus on the syllabus. Transfer and sale of property, that provisions alone please read. Rights and liabilities of buyer and so that provisions alone please read. Okay. So there will be one more session on day 6. And please tell me which are all the areas you want us to discuss, whether on macroeconomics, general laws, because general laws is 17 marks. Okay, you tell me which areas we need to discuss. Now, whether we need to do a session on the judicial pronouncement, because it's only 1 mark, situation specific valuation, because that will also form part of your case studies. Anyway, I'll be doing case studies on this. On startup, I'll be doing case studies. On SME enterprises, I'll do case studies. So very interesting syllabus. Syllabus is quite vast. I'm telling you, quite vast. Okay, good. Now, whenever there is a movement of this, okay, there will be an impact on your price. When your present price, spot price increases, okay, your call option will increase and your put option will decrease. I will now explain this with some examples. Okay. All of you, please pay your kind attention. Please pay your kind attention. And remember, this question is definite in your exam. Okay. And at least 1 question will come 1 mark, or 2 questions are sure. So 2 marks are only from this table. From this table, 2 questions are definite. These are all the 6 variants. And as the variants, these attributes go up, what will happen to the call option and put option? Look at this. Okay. Now, I'll give an example. If there is a 3-month option contract, the option premium is 40 rupees. If there is a 6-month option contract, will the option premium be same? 30 rupees. 3 months also 30 rupees option premium. 6 months also will the option premium be same? Not necessary. As the time goes up more, your call premium also will go up. Put premium also will go up. Because risk is more. Okay. Now, same is the concept I'm going to apply for everything, and please look at this. With the increase in spot price, look at this, spot price goes up. Okay. If the spot price goes up, what will happen to call option? Call option also will increase. So 5A. Okay. Now let me ask you another question. As the time goes up, increase in time means that call option also increase. Just now we discussed that. Time. And time and put both will increase. So it is 8D. Okay. Now I'll take you one more question. With the dividends going up. Okay, dividends going up. Now, dividend is a place where you need to be very careful, because especially if it is ESOP, vesting will be there, allotment will not be done. So then, because he is not at received, he is not at owned the. Now, if it is a put option, he is holding the shares. He will sell the shares. Now, the obligator is obligated to buy. Now, will he get that particular dividend? So we need to understand this dividend portion. So I will wait for some time. The Black-Scholes Merton. Merton is a guy. Black-Scholes guy. He gave the BSM formula, Black-Scholes model formula, with 5 factors. Black-Scholes Merton. The Merton added further research on that, and he gave a formula with 6 factors, and dividend is the 6th factor. So with the increase in dividend, the value of call option will come down, so decrease. So it is 12B. Okay, please understand this part. Now, I'll now take you to another interesting. Now, a reverse question. A ulta question. Look at this. The value of the call option decreases. Call option decrease in only 2 places. Look at this. The value of call option decreases only when dividend increases and exercise price increases. Call option will decrease. Call option decreases due to change in which of the following factor, not factors. Of course, there are 2 factors, but answer is only 1. Okay, of option valuation. Increase in dividend, increase in strike price. Longer expiration, that is time, no. Extent of volatility means variance, no. Increase in interest rate, no, because increase in interest rate, call will go up. Increase in strike price increases, call will decrease. So increase in strike was 17A. Please understand this. These are all very important questions. So whenever you get this question, they will give you a paper. In the paper itself, put the dabba and top, increase, decrease, and all you put it. Immediate answer, immediate 1 mark, 2 mark for you. Now, look at this question. One more question. Maybe I'll just, because this is call option, I'll put a question, a put option. I'll put another question. I think this will be 19th question. Let me think. Value of put option increases. Put option increases where 1, 2, 3, 4 circumstances put option increases. See, these kind of question is not that easy. I'm telling you, these are not difficult also, but these are mediocre. Okay, these are mediocre. Now, please understand this table should be there in your mind. Then you can actually appreciate this question much better. Value of a put option increases. 4 circumstances it will increase. Due to change in which of the following factor of option valuation? Decrease in volatility. Volatility is variance. Increase in variance, increase in put. So increase in put, but there is a decrease in volatility. So wrong. A is wrong. Increase in interest rate. Increase in interest rate, put decreases. Increase in interest rate, put increases. So that is also wrong. So question and answer doesn't go together. Longer expiration, time. So time increases, put increases. Very good. So C is your answer. 19C. But let us see, D is also wrong. Increase in spot price. Spot price increases, put will decrease. Here put is increase. So wrong. D is also wrong. 3 wrong answers, 1 right answer. So you have to be very careful. Unless and otherwise, this entire 12 circumstances you are clear. Govinda, gone. Question gone. Okay. Now, what do you mean by a naked option? Okay. Remember, guys, naked option means, for example, I am a call holder. What is a call holder? Option to buy. Now, writer is obligated to sell. Now, when I exercise the option, if the obligator, writer, doesn't have the stock to sell to me, what will happen? He is having the risk of going to the market, buy and then deliver it to me. Okay, that is called naked options. So that means he is not prepared. So generally it will happen to, I used to say valuation, examination, you go. You are not prepared for the question. Then it is called a naked question. So you don't know. You become naked before that question. You are exposed to that particular question. So because you don't have the stock with you. Options that do not have stock in portfolio to back up. That is called undue option, due option, total option, naked option. Now, what will happen to naked option? When you go to the market and buy, see why I am exercising the options? Exercising the options because option to call option, option to buy. Market it is 48, but the exercise price is 40. So I will not buy in market, I will buy at 40. But you don't have the stock. You go to the market at 48 and you sell at 40. So you will make a loss. So please understand this. So 22 is D. Sorry, 22 is A. Okay. So that is naked option. Now, how do you value options? Okay. So these are all the 4 models. Black-Scholes model, Black-Scholes Merton model. So this is called BSM model. This is BS model. Black-Scholes model. BSM model means Black-Scholes Merton model. There is a difference between these two. So please wait. Binomial model. Monte Carlo simulation model. Of all these models, Monte Carlo will be the lowest in terms of simplicity. Monte Carlo simulation will be the complex in terms of valuation. Black-Scholes Merton model is a formula application, and for your information, in finance, Black-Scholes Merton has got Nobel Prize. Okay, Nobel Prize winning model. Okay, so please look at this model. I just want to share with you one very, very important look at this. Merton and Scholes received the 1997 Nobel Memorial Prize in economic science for their work. The committee citing their discovery of the risk-neutral dynamic revision as a breakthrough that separates option from the risk of the underlying security. Now, actually, Black-Scholes, Merton, both all the three should have got the Nobel Prize money, but although ineligible for the prize because of the death in 1995, Black was mentioned as a contributor by the Swedish Academy, and the memorial prize was not. So he was that recognition was given, but prize money was not there. So only those who are alive, they get the prize money. Okay. Now come to this question. These are all this is binomial model. There are two types of binomial model: single period binomial model, multi-period binomial model. This multi-period is the binomial tree model. Okay. And in your syllabus, please look at the syllabus. This is your syllabus. Where is it? This is your syllabus. What it says, binomial tree method only. So in your binomial model, even though you have single period and multi-period is only included in your syllabus. But to understand multi-period, you also do a single period. There are 1 mark question that has been asked. Even though binomial tree alone is mentioned, so single period model also can be asked for a 1 mark question. It's called delta hedging model. Okay, 1 mark question. And binomial tree model can be a case study question, which can be your 6 mark question or an 8 mark question. Okay, so this is a single period model. And for example, I'll just share with you. I want to make one observation. There is something called volatility we just now discussed, because I'll come to this. This is Black-Scholes model. I'll just explain to you how Black-Scholes model also works, how the other model also works with example. Now here, the current price, all of you know, today's market price. Strike price is exercise price. 3 months later, you want to buy. It's a call option. Risk-free rate is the interest rate. Now, what is volatility? Volatility is sigma. That means standard deviation. And volatility is a generic term, whether it refers to sigma or sigma square. Because look at the formula. Here, sigma square is there. So therefore, sigma square is variance. Okay. This volatility is a generic term. Sometimes volatility refers to standard deviation without square, and sometimes it will even refer to variance also. Variance, volatility. Volatility, standard deviation. Both are interchangeable. This is a generic term, but the statistics term is standard deviation and variance. Variance is standard deviation square. So we need to understand all these concepts a little bit. Now let me come to this question. Now this is a simple question on what do you call it as binomial model, single period model. Okay. Now this is a binomial option pricing model, single period for call option and put option. These are the formulas. I'll now explain this with an example. Okay. So what is this delta called as? What is this borrowing called as? Okay. Now I'll just explain this with an example. Now let me open that particular example. Okay. Yes. So please wait a minute. Yes. Yes. This will be our. So what I will do, I'll first take you to a simple question. First, I'll explain the volatility part. So this is an IPL season. So say like there are 2 players I'm going to analyze: Mahendra Singh Dhoni and Virat Kohli. So let us say it is a season 1 and season 2. In season 1, Virat Kohli is actually 90, and in second season he gets 0. So what is his average? Okay, his average is actually 45. Now Mahendra Singh Dhoni, the first season, his average is maybe he takes 50. In second season he takes 40. Now what is his average? That is also 45. Okay. Now I am asking, see, this is what I said. Variance is standard, both are volatility only. Okay. Now what is variance? This is 50 minus 45. Okay. The whole square. Okay. That is 5 square. Okay. The whole square. Plus you have 45 minus 50. Sorry, 45 minus 40, which is minus 5 whole square. Okay. So this is what you have to add. So that means 5 square 25 minus 5 square 25. 25 plus 25 50. Now look at the same variance for Virat Kohli. That is 90 45 90 minus 45 45 square. 0 minus 45 minus 45 square. My God, 4050. Now what is standard deviation? Square root of 20. Okay, actually this is variances by 2 you have to put. I have to put this is by 2 because there are two innings, So here also I have to put by 2. Now what is standard deviation? Square root of variance. Now what is square root of 20? 45. Look at this. Actually, you don't need any statistics at all. There is a variance of 5. There is a standard deviation of 5 runs. Here is a variation standard deviation of 45 runs. Very simple. Plus or minus 5, plus or minus 5. 45. Now, who is riskier? Who is consistent player? Consistent player and risky player. Consistent player is where the volatility is very low. MS Dhoni. Risky player is Virat Kohli. Okay, because of this number. So this is what is fundamental. Now I am taking you to a call option. Look at this. So what I will do, I'll remove this. These are all the formulas. So I'll just remove the formula also. I'll just explain this concept of call option valuation with respect to binomial model. Okay. Now what is this binomial model? Now there is one way of doing it. Your price can go maximum upward, maximum downward. These are the two extremes. What is this buy? Buy means 2. What is this 2? There is an exercise price. What is the worst scenario? What is the best scenario? Worst scenario is what will be the maximum loss. What is the best scenario? What is the maximum gain? Matter over. That's all. Now, this is actually, we call it as the 4-step process in binomial. Now, who will be valuing this call option? Okay. Now, who has to charge the option premium? Writer, call writer have to charge to the call holder. Now, who's the call holder? Option to buy. I have an option to buy. Price when it is cheaper compared to market, I will buy. Else I will not buy. Now, with respect to call writer, how will he charge? Because he has to sell. That means he has to keep the stock. So now please look at this. So first step, he will borrow money. Second step, he will invest the borrowed money somewhere. Okay. He borrows money, he will invest. Third step, when you exercise the price, when you exercise the call, that means he needs money to buy. So what he will do, he will sell the asset and settle the borrowed money. Okay. So actually, what is the meaning? This is called equivalent portfolio. Borrow money, invest the borrowed money. What do you mean by invest the borrowed money? He will borrow the money, he will buy the stock and keep it. Okay. And what is step 3? You exercise, he will sell to you, get the money. And he has already borrowed money, so he will settle that money. So matter settled. Simple. That is what now in this process, there will be a cost to the option writer. That cost we are going to find, and that cost only he will charge today. So this is the equivalent portfolio model. Now how this works? Okay. Now what is the spot price in this question? Spot price in this question is 70. Okay. And exercise price is 78. Okay. 78. What is the interest rate? 8% per annum. And 1 plus interest rate is 1.08 or 108% or 1.08. And what is the worst scenario? Price can go up to 0.9. Okay, 0.9. Now, what is the best scenario? Price can go up to 1.5 times. That is upward price. So, what is the price it can go? US means 1.5 of 70. So, it can go up to 105. What is DS? It can go down up to 63. So, now what is the call option? This is actually called intrinsic value. Intrinsic value means we already know strike price minus, we already saw that strike price. What is the Now, with respect to call option, what is your intrinsic value? Look at this call option. We already saw that. This is your intrinsic value. This is your intrinsic value. Look at this. Intrinsic value. Current stock price minus strike price, exercise price. So, this is your current stock price. It can go up 105. What is your exercise price? Exercise price is 78. Now, if your market price is 75 and exercise price is 78, it's a call option. Will I exercise or not? Yes, I will exercise, because what is the gain for me? The gain will be the maximum of is 105 minus exercise price 78, 0. So I will get 27 rupees gain, because market price is 105. I will not buy at 105. I will buy at exercise price 78. No, reverse. Worst scenario. Market is 63. Why should I buy at 78? I will make a loss, no? So what is the loss I will make? In case I will exercise. So it is 63 minus 78. That will be the loss. So what is 63 minus 78? It is actually 15. Okay, 15 will be loss. Or I will not exercise. If I don't exercise, my loss is 0. So I'll keep it as 0. I will not exercise. So now what is the delta? Delta is actually a hedge ratio, and there will be exam questions on delta. Please understand this. Now what is delta? Please come to this particular part. Delta is, will you buy the entire stock and keep it? No. That is a percentage only you will hedge it. Delta ratio is called hedging ratio. See, there is a contract for 100 shares. The entire 100 shares I need not buy and keep it. But I will keep at least 30% share, 40% share, 60% stock I will keep. Please understand that. Somewhere middle he will keep it. That is why it is called delta. Okay. So it is CU minus CD by U minus DS, or US minus DS. CU minus CD minus US minus DS. What is US minus DS? That is the extreme price. Now what is this? Call option, upper call option, and that is what do you call upper price intrinsic value, down price intrinsic value spread divided by market price spread. That is the message of this delta, and that will be an exam question. So this is CU minus CD, which is 27 minus 0, divided by U minus DS or US minus DS. So what is US? 105 minus 63. So 27 the spread divided by the spread of the price. So this is your hedge ratio, 64.29%. You will actually hedge. You have to keep the portfolio. Okay. Now, to keep that portfolio, you need borrowing, you need money. So how much money you need? This is UCD minus DCU by U minus D into R. So this is U into CD. CD is 0 minus DCU. Okay. So what is DCU? D is 0.95 into CU, 27. So this is numerator divided by denominator. So what is your denominator? U minus D. U is 1.5 minus 0.9 into, this is the, your investment will multiply, no? So because when you borrow money, you have to repay with interest. So that is your repaying with interest. So therefore, it is this. So very, very simple logic, but you have to appreciate this formula logic. So this borrowing is a negative because you have to borrow money. Okay. Technically, it is a cash inflow, but you have to repay. That is why it is negative. Now, what is your call option? This is delta S plus borrowing. And technically, you have to repay. So it is minus borrowing. Already minus is in formula itself, it is in minus. So what is your delta? 64.29 into spot price 70 plus borrowing. Borrowing is 37.5. You have to repay. So 7.50 will be the cost to the writer. And that 7.50, you will charge it to the holder. This is 7.5. Now answer this question. So what is value of 7.5? So 23B. This is how it will work out. Now I'll come to a question on this. These are the Black-Scholes model. I want to add some questions on Black-Scholes. Originally, Black-Scholes model was developed in 1973. Okay, their full name is called Fisher, Black, Myron Scholes, and Robert Merton. Okay, so it's a 1973 model, and they got the Nobel Prize only in 1997. Okay, so for your information, and Black-Scholes model follows log normal distribution. Okay, this is the log normal distribution. So Black-Scholes model assumes a uniform continuous probability, triangular continuous model, Poisson continuous model, log normal. So 24A. Okay, and most important, Black-Scholes model originally was developed for European option. Later, European option to be exercised only on the exercise date. But later they extended this model, and so many research have been put on Black-Scholes-Merton model. And today it is applicable by default for various applications, including American options, and you have the Bermudan options and all. But originally was mainly developed for European style options. So 25A originally. Okay. Then these were the first 5 parameters. Black-Scholes-Merton is not there. Only Black-Scholes is there. So originally Black-Scholes without dividend, that is the first 5. The current stock price, the exercise price, risk-free rate, volatility, time to expiration. These are the 5 factors. Now look at the 5 factors. Stock price, exercise, discount. There is nothing called discount rate. So D wrong. Economic price wrong. Sale price wrong. Stock price yes. Exercise price yes. Risk-free rate yes. Variance yes. Time to maturity 5. So it is 27A. Okay, good. Now I'll come to this. The method of adjusting cash dividend. This is a model which was introduced. Further research was done on Black-Scholes model by the Merton. Okay, Mr. Merton. So there are 3 guys. Robert Merton, and his model was merged with. So his additional finding. So he said, okay, now what if during the period, for example, there's the call option. What is the call option holder? He has an option to buy. Now put option, right? I mean, the call option holder has to buy the stock and keep it. Now if he buy the stocks and keep it, he will get the dividend. If he gets the dividend, he gets the income. If he gets the income, will he keep the income? No. That income he will reduce from the cost. He will reduce from the cost. That is why, look at the concept here. Dividend. Okay. If there is an increase in dividend, call price will come down. Why? He gets income. If he gets income, there is a cost of 9 rupees. Dividend is 1 rupee. He already receives it. Why should he get 9 from him? So 1 he is already received, no? So he will only get the difference of 8 from the call holder. This is a concept. Each and every concept try to break the reason why it is increasing, why it is decreasing. Okay. Now, I'll now take you to a very important part. This is one more question. Which method is not used for oiling options? Black-Scholes-Merton, binomial model. You have the single and tree model, Monte Carlo simulation, and time series. Time series is not an answer. So 32D. But remember, what is Monte Carlo? This guy is a very popular guy. Monte Carlo. Now, Monte Carlo simulation. What is simulation? This is a very popular model today. Of course, what is simulation? Flight simulation. So before you fly a flight, they will sit in a cockpit and they will give you one software and you will try to. Nowadays, there are a lot of flight simulator games are also there. Okay. So you get the feeling. Similarly, a lot of simulator games are there. Of course, maybe if somebody has developed a post-marriage simulator, so we will go and sit in that particular game room. So after marriage, what will be the circumstances the person will be facing? So if that simulation experience is there, he can take a decision whether to marry or not. Okay. So very similar to that Monte Carlo method of option pricing. Okay. So he will there will be scenarios. Scenario 1, scenario 2, scenario 3, scenario 4. So in binomial, only 2 scenarios are there. Extreme plus, extreme minus, only 2 scenarios. Monte Carlo, okay, what if, so we have this rows and all. She will say yes, she will say no. She will say yes, she will say no, like that. So what if 150 rupees, 70 rupees, 110 rupees, 45 rupees, 190 rupees, 160 rupees. So then what will be the impact and what is the probability for that? And then arrival. So that is why it is a complicated feature, multiple sources of uncertainty. Okay. The original application to option pricing by Selim Boyle. Okay, he only brought this, and these are all some names. You need not worry about it. But these are all the steps to the least square Monte Carlo simulation. Okay, so this is the two-step process and all. Not much as of today in examination. This is your syllabus. In syllabus, you have option valuation model. So far, they are not asking any case study on Monte Carlo, but possibly there will be one question on concept question. So Monte Carlo option model uses multiple uncertainty and complicated scenario. Okay. So any multiple uncertainty or complicated features, and they will find an answer for it. So this is either or. So either A or B. So 30B. Okay, good. Now I'll now take you to this is what I just now discussed. Option delta, that the triangle formula, no? It is a ratio of the spread of possible option prices. What is the option prices on top? You had CU minus CD divided by US minus DS. Spread of call option prices divided by excess divided by the market price. Okay, spread of the market price. So spread of the possible market price, spread of the possible option price. Spread of the option price divided by spread of. What is this? It is called hedge ratio. Option delta. Look at this formula. This is option. This is a delta. This option delta is otherwise called the hedge ratio. Okay, 33C. Now I want to give you one more interesting question, ulta question of the same. Option delta is calculated as a ratio of numerator will be spread of the possible share prices wrong, because share prices will come in the denominator, US minus DS. What is US? Upper price, upper circuit price, DS, lower circuit price. Okay. Okay, good. So possibility of spread of possible share price wrong. Numerator share price option price wrong, because spread only we will take. Okay. Spread of possible option price is numerator. Spread of possible share price is denominator. Correct. 34C is your correct answer. Very, very interesting question. Now, I'll bring it to you one more interesting question on this. I want to ask another. Say, you have this delta. I want to make one more observation. There is one more interesting question. I'll just ask this question. See, you have this option delta ratio. This is for call option delta. Now, put option delta. Put option delta, how will you get? Okay. So, almost same, but will it be U minus D? Now, I'll just show you that formula also for put option. This can also be an exam question. Look at this. This is call option, okay, delta formula. U minus D by US minus DS. This is put option delta formula. This is lower price minus upper price divided by spread of the price. Slight difference. Now, I want to make one observation here. Okay. See, I'll just bring it to this question. This is the same question. Okay. Now, this is call option. Now, I'll put the put option for the same question. Will the option delta will be 64.29 for the no, it will not be 64.29. It will be exactly 1 minus this delta. Okay. So this is what is 1 minus delta? I'm sorry. So this is 1 minus delta. This is exactly 35.71. The same question, if you take the option delta for put option, it will not be 64.1. It will be 35.71. Okay. That can be one more question I'm asking. I'm just giving you the hint to all of you. Okay. But now, please look at this. These are all the other option Greeks. Okay. The fantastic five. This is delta. Delta means change in prices. Theta means change in time. Time means what? 3 months, 6 months. So theta is T. Time is T. Gamma represent the change of the delta relative to change in the price of the underlying security. Vega. Vega means change in the volatility. V. Your standard deviation. Rho. Okay. Rho is the change in the interest rate. So R means interest rate. Okay. So very, very important. This can also be a 1 mark question. Now let me come to this question. Look at this. Okay. Change in spot price. Okay. Or change in the prices. Delta. Change in time is theta. Change in standard deviation is vega. Okay, V means volatility. Change in risk-free rate, R, rho. Okay. Now, look at this. Which of the following measures the impact of a change in stock price? Impact of the change in stock price. That is your delta, 35C. Okay. And what is the impact of change in time? Time means theta, not vega. Vega is change in your variance. Okay. Change in your standard deviation. So 36D. Okay. Good. Now, which of the following will be an impact in interest rate? Interest rate means R. R means rho. So 36B. So, sorry, 38B. So please note down all the small. And actually, I discussed only one formula. This is the only one formula I discussed for option Greeks. That is called delta. Like that, you have one more, you have another 4 more formulas for theta calculation, gamma calculation, vega calculation, rho calculation. You have separate formulas, but slight changes will be there. That's it. Nothing more. So once you do all these calculations, I'm sure you will be a fantastic, okay, a fantastic valuer. Okay. So very interesting questions. And I'll just share with you the various exotic options. Okay. So what is an exotic options? Okay, this can also be an exam question. Now I will just share with you one more interesting part in exam question. Now look at this part. Oh, sorry. There can be question on financial asset. Okay, what is meant by a financial asset? There can be a question on your valuation of what is this? You have the syllabus, no? This is your syllabus. Valuation of financial guarantee and warranty. Warranty valuation, how will you do? I'll just share with you one very simple example. Look at this. This is an example from India is 37. Oh my God, from where? What is 37? 37 is provisions, contingent liability and contingent assets. Okay. Now, an entity is selling a goods with a warranty under which customers are covered with cost of repairs of any manufacturing defect that becomes apparent within first 6 months after purchase. Oh, if minor defects were detected, repair cost will be 1 million would result. Major defect means of all products. Okay, look at this, not one product. The repair cost will be 4 million. Now, from the past experience, 75% goods will have no defect, 25% goods will have minor defect, 5% goods will have major defect. Okay, so this is what your estimation technical provision from India is 37. Okay, the entity can use the following technique to determine the best estimate of the provision: weighted average, all possible outcome, or the single most likely outcome. Anyone. This is weighted average valuation model or a single most likely outcome. That also you can take. So here 0 into 75%, 1 million into 20%, and 5% of 4 million. So 4 million is actually 40 lakhs. 40 lakhs, 5% will be 2 lakhs. And 10 lakhs, 20% will be 2 lakhs. 2 plus 2 lakhs is 4 lakhs. That's it. So this is how the valuation is done. And you may get multiple answers also. Maybe you will get 0, you will get 2 lakhs, you will get 4 lakhs, you will get, another 1 lakh, like that. So you have to be very careful with these kind of answers. Okay. So guys, let me now come to the review. Okay, your reflections. So let me now ask Mr. Binoy. Mr. Binoy, I'll just unmute. You can just share your thoughts. And I'll also unmute Rohini Verma. I will also unmute Girish. Girish also I will unmute. Let me also unmute Madhav Agarwal. I will also unmute Mr. Giridharan. Good morning, Mr. Giridharan. You can share your thoughts, sir.
Good morning, sir.
Very good morning.
Yeah. I've been attending your classes at various periods, sir. I'm yet to give a successful attempt due to various reasons. Probably I'm not giving that importance that, the material is so vast. Like today you said, no, the syllabus is so vast that I'm not able to cover it properly. But obviously all your funda questions and other materials are very, very resourceful. Thank you so much.
Thank you. Thank you. So can you introduce yourself?
Myself, Rohini Verma. I'm a practicing company secretary from Chennai.
Okay, good. So, Mr. Giridharanji, good morning.
Good morning, sir. You are a role model today in explaining the various models. Black-Scholes method model. Only apprehension is with all these models, we have to walk on the exam ramp model. We should not feel lost while calculating the model. One thing I want to explain to you, you are doing it all on the Excel sheet. But in the examination, all these calculations we have to do with the help of a calculator, I assume.
No. So, Giridharanji, actually, there are two possibilities. One is they may give a open office. There is an open office equivalent of Excel, or in certain centers, they even provide Excel itself. So, they give you a tool. So, you can go to that one office and you can open that spreadsheet. So, there will be some spreadsheet tool they will be providing to you. So, no need to take any calculator. So, you can take a calculator also, but the spreadsheet will be available.
Okay, thank you.
So, Mr. Manjunath, good morning, Mr. Manjunath. You can also share your thoughts. Anybody else who wish to share your thoughts, please? Mr. Balarama Prakash. About Ramasamy Sudalai Muttu. Let us listen to Mr. Ramasamy Sudalai Muttu. Good morning. We'll also listen to Preeti Pungodai. Yeah. Padmini Sridhar is there. Good morning.
Good morning.
Yes.
Am I audible?
Absolutely audible. Please go ahead.
First of all, thank you so much for all the sessions, and I have been attending off and on. I haven't been very regular to attend the whole session, but this time I wish to attend it and give my full to take the exam. I haven't yet taken the exam. I hope to spend a good time with your help and with all the classes that we've attended with you. Hopefully we should make it this time. Thank you so much again. I have only one question. Is there one place, the repository or some place where we can have access to case studies to solve more of them? Because from what I see online, I'm not seeing much of it, and the classes that I had also attended, the 50-hour sessions, didn't have much. So is there some place where we can access and do more practice?
My suggestion is please revisit your CA final latest study materials. That will give you a lot of exercises material available to get again a grip on the fundamentals. Then there are a lot of textbooks available. So those textbooks you can just follow. That will give you the grip.
Thank you so much.
Yes, Jitendra Jain, good morning. Good morning, Jitendra. Okay, so let us now listen to Sampatji for closing remarks.
Hello, sir.
Jitendra, yes.
Yes. So today's class was like so much insight on the options and like Valuation, a lot of clarity on the subject. So similarly, like example, like after your classes, there was one thing which I found it like there were and we can directly go and see whether need not believe GKR material or institute material. After your classes, I know where to directly go and check whether what is correct. So I will directly go to the standard and check that was some error in the instrument. So we get so much of clarity after your classes. So thanks.
Good. Best of luck. So Sampatji, over to your closing remarks.
Dr. Raju and my dear friends, today's coverage, options valuation under the fixed income securities category. Starting from what is a call option, option to buy, obligation to sell, and what is a put option with a number example. So much has been capsuled within this 1 hour. And to do the justice to the entire content within 5 days, it's a humongous task giving whatever that is possible within the given time. Thank you, Dr. Raju. I request on behalf of all the participants, with the hoping sincerely for a response from them or a request from them for the 6th day session also. Thank you, Doctor.